You need to realize that money is a tool and not just a goal. Hi everyone, this is Charm again from Ready to Adult Philippines, a channel about personal finance, entrepreneurship, and adulting how-tos. For this video, I'm finally addressing a topic that a lot of people, and by people I mean my friends on Instagram and Facebook, want me to talk about. What is investing? Investing is a broad term and we hear it being used in phrases like, I want to invest in a good night's sleep, I want to invest in a relationship, or I just invested in a bag or jewelry. But that's not the kind of investing we're gonna talk about today. Investing is a term generally used when you put in time, effort, and especially money with the goal of achieving a return in profit or material results. I'm gonna focus on investing in terms of achieving profit for your financial goals. With investing, we usually get intimidated with all the jargons, numbers, and percentages. So we're gonna try to cover that today by tackling the why, the what, the when, the where, and the how. And the first is the why. Why should we invest? So the first reason is inflation. If you remember in your economics class, inflation is the general increase of the prices of goods and services over time. That means that your 100 peso today will not be worth 100 pesos in the years to come. An example of that is the price of movie tickets. When I was still in high school around 10 years ago, the price of movie tickets were 120 pesos. And today, it's 220 to 240 pesos. In the last 5 years, the average inflation rate in the Philippines is 2 to 3%. That means that if you're saving your money in a low-interest savings account, meaning it's less than 1% per annum, then you're losing money to inflation. And that's one of the reasons why we should invest. Reason number 2 is compounding interest. Compounding interest is the addition of interest to your principal sum, or to simplify, it's interest on top of interest. This works if you invest your interest income rather than paying out. A method used for estimating the doubling time of your investment is the rule of 72. This works by dividing 72 with your annual interest rate, then you'll get the doubling time of your investment, or how many years it will take for your investment to double. So for example, you invested 100,000 at 6% interest. 72 divided by 6 equals 12 years. So in 12 years, your 100,000 will now become 200,000. And in another 12 years, your 200,000 will become 400,000. This is why compounding interest is a great reason to invest, especially if you're younger. The third reason is a 2-in-1. Putting your money at work to achieve your financial goals. And you can do these by investing. Our system has taught us that if you work harder and you study harder, then you get better results. And people seem to think that the only way to make money is to put in more time and more effort. But what happens if you can't work anymore, or something happens to you that disables you from working? What happens to your cash flow and your income then? Investing your money makes your money work alongside you so that in the future, you can achieve your financial goals. And the most common one is retirement. Everybody wants to retire. So investing is really a great tool, especially if you're in your 20s or 30s. Next is the what. I'm not gonna tell you what investing is again, but I'm gonna tell you that you need to know what type of investor you are. It's important to know that every investor is different, so knowing your investment personality and knowing the why behind your investing will help you determine what types of investments you want to get into. First is, what is your time horizon? So the time horizon is how long you want to stay invested. So there's the short term, medium term, and long term. For the short term, it's usually 1 month to 3 years. For the medium term, it's usually 4 years to 10 years. And then for the long term, it's more than 10 years. Long-term investments are the most ideal because of what I said earlier about compounding interest. Compounding interest is like a snowball that goes faster as time goes by. So if you invest in the long term, it's more likely that your money will grow faster. Number 2 is, what is your risk level? So for the risk level, this is the conservative, the moderately conservative, moderately aggressive, and then the aggressive. For the conservative, this is for people who just want to try to beat inflation. So this is around 1 to 3%. For those less than percent, I barely consider them investments, but they technically still are. For the moderately conservative, it's around 3 to 5%, and it's for people who still want to feel secure, but they also want to try to grow their money. For the moderately aggressive, it's around 6 to 8%, and it's for people who want to grow their money faster. And lastly, the aggressive, which is 8% and above. With these 4 risk levels, it's usually the lower risk, lower returns, and higher risk, higher returns. But it's also great to spread out your money across 4 risk levels. The third one is, what is your goal? It's important to determine what your investments are for. Is it to buy a property? Is it for your kids' education or for your retirement? I label what my investments are for so that I also know how much I need to save up. And the fourth one is, what is your budget? So knowing your goal, you already know how much you need to save up. So now is to determine your budget. I would recommend around 20 to 30% of your income. But if you're still starting out, you can start at 3% and then 5% and then move up from that. And ideally, you automate your investment if that option is available. If you already know what type of investor you are, the next is the when. When is the wrong and right time to invest? For the wrong time to invest, there isn't technically a wrong time to start investing because experts would tell you to do it as soon as possible. But personally, I would tell you not to invest if you don't have an emergency fund, because you should never use your emergency fund, which is 3 to 6 months of your monthly expenses. You should never use that to invest, because if you might need it and there is an emergency, you can't get it right away. And the next is, if you're still paying a high interest debt or you have a loan, then try not to invest first, especially if your investment's interest is lower than your debt's interest, because the math just doesn't work. For the right time to invest, as I said earlier, I would suggest as early and as young as possible because, again, of compounding interest. I don't need to say it again. This is the third time I've mentioned compounding interest, but you get my point. And the next is the right time to invest in terms of frequency. So I would suggest every paycheck or every month. And it's really great if you can have it automated so you don't have to manually transfer it to your investment accounts. Next is where to invest. So I'm not gonna tell you where exactly to invest, but I'm gonna tell you the different kinds of investment. And I like how the book Investing for Dummies dumbed it down or simplified it to 2 categories of investing. First is the lending and the second is ownership. So for the first is the lending investments. So these are investments where you borrow money to the government, to companies, or to other people. So first is the government. If you're an employee, you would know that you are giving contributions to SSS, Pag-ibig. These are actually investments. Like SSS is for your retirement and Pag-ibig is for your loans or housing loans. And there are also government bonds. So next is lending money to companies. So you're actually lending money to banks through your savings accounts. That's why you earn a small interest rate. And it can also come in the form of corporate bonds. Corporate bonds are similar to government bonds. They work like this. If you give money to a company or the government, they have a set period of holding time. So it can be 1 year or 5 years or 10 years, but it's a fixed interest rate. So for example, you have 5% interest on your bonds and the market goes down to 3%. It's great for you because people want to go to the higher interest bonds. But if the market percent goes high, then people are less likely to get your bonds. Next is lending to individuals. And I'm not talking about lending your neighbor some money. I'm talking about P2P lenders. It's person-to-person lenders. It can be direct from one person to another, or you're a pooled fund and then you give loans to people. If you have in your company co-ops, that's one form of it. Next is the ownership investments. So this is in the form of stocks or equities, properties, or businesses. So for the stocks and equities, this is when you buy shares from companies, mostly publicly listed companies. and this is done through a brokerage. There are online brokerages and physical ones. Next is real estate. This is pretty straightforward. You buy or own a property, but there are still risks because it's not guaranteed that the value of your property will go up, but you can make money through rental income. And the last for the ownership type of investments is business. So obviously, having a business, you're the owner of that business. You own stocks and equities to your business. I made this separate because if you own your own business, there's more room for growth and for profit. So those are the two types of investments, the lending and the ownership. There are actually vehicles that allow you to invest in both at the same time. You usually hear the words UITF and mutual funds. So to explain, balanced UITFs and mutual funds invest in both lending types and ownership types of investments. So for the UITF and mutual funds, they're actually pretty similar but also different. How they work is that they pull money from different types of people, and then this pool of money, they then invest it to different types of investment. And then whatever they get from that, they then distribute it to the investors, which is us. These pools of money is actually handled by fund managers. So with a mutual fund, you're actually invested in a company that does investments. So this is governed by the SEC, or the Securities Exchange Commission, which handles duly organized corporations in the Philippines. And the value is called NAVPS, or Net Asset Value Per Share. And they also give out dividends. For the UITF, it's a pool of funds, and it's governed by the Bangko Sentral ng Pilipinas, or the BSP, and the value is called Net Asset Value Per Unit. So you actually own units of the fund. For the mutual funds, you actually own shares of that mutual fund company. So for the UITFs, instead of getting dividends, you get UIP, or Unit Income Payouts. I know it's a bit confusing, but that's the simplest way I can explain investments, which is the lending and the ownerships, and then those that invests in both. And I can do a separate video about this, but not now because it's gonna get lengthy and we still have the how to tackle. And we're down to the last one, which is the how. I broke this into two parts: the how do you earn from your investments, and then how to invest. So those are more of tips. So first is, how do you earn from investments? So you earn from your investments through interest income, which is the revenue you get from the interest. The second is dividend income, which is the distribution of companies to their stockholders, and usually this is done annually. And the last is capital gains, and this is the rise in the value of your assets, or the appreciation of your assets or your principal. And next is the how-tos, or the tips. And I have three, and these are based on personal experience. The first, and you've probably heard this a lot, but it's true, and it's to diversify, or not to put all your eggs in one basket. Like I said earlier, it's also good to look into diversifying it across 4 risk levels. Next is, don't try to time the market, because it's your time in the market that matters. That's not an original line, but I really agree to it. I tried to time the market when I invested in a UITF, and what that did was just delaying my time to be in the market and for my money to earn. What I usually do in the money market, or when I invest in stocks, is use peso cost averaging, meaning I invest a certain amount every month, and what usually comes out when I average it, like this table shown in your screen, is I usually still earn more, especially if I stay in the market longer. Next are more of terminologies, but it's understanding paper loss and gain realization. So for paper loss, meaning if you're invested in the money market right now and you bought it at 1,000 pesos per share, but the market is now at 980 pesos, then you lost 20 peso per share, right? But that's just paper loss. As long as you don't withdraw your money, you're not really losing money. And another word to understand is gain realization, meaning you only realize your gain when you actually withdraw your money as well. So when your 1,000 peso becomes 1,020 or 1,050 peso per share, you don't actually realize the gain unless you withdraw it as well. And that's it. The why, the what, the when, the where, and the how of investing. And if you haven't seen my videos, I will leave links down below. If you like this video, please click like and then subscribe to this channel and hit the notification bell, and share this video to your friends and families who want to know about investing as well. So again, this has been Charm for Ready to Adult Philippines, and I will see you in my next video.